Hey, what's up guys? Today we're going to talk about higher time frame trading versus lower time frame trading. Because again, as a smart money trader, we believe in the fractal nature, meaning what happens on a 4-hour time frame happens on a 1-minute time frame or even more lower. And today we're going to explain on how to trade lower time frame analysis and what's the pros and the cons in trading this, and if it's or is lower time frame trading a good fit for you. So right now we're on EU as usual. Again, we're in a downtrend because we see a break of structure here. Same thing over here, still a break of structure. So again, if you've been watching my videos, super bearish on EU, but currently we still don't know when is the end of this bearish push down on lower time frames. So if we see a structural shift on a specific time frame or on a lower time frame, let's just say on the 4-hour, then it's possibly following a larger time frame, maybe the daily or the weekly time frame, to go higher, come mitigate this OB at the same time, come mitigate this imbalances, then continue to the downside, since overall on larger time frame we're still bearish. And again, you can check my top-down analysis on how to do top-down analysis on market structure. I think that's the title of that previous video, but we talked about how to do top-down from the 12-month down to the daily, I think. Then if you remember that the daily, let's just go back, let me just show you. At the daily, we're still currently bullish on the specifically on this daily time frame, and we concluded that the possible reason or why market is forming a bearish trend at this point over here at the 4-hour time frame, or even on the 12-hour time frame, why is it forming a bearish trend, is again, it's possibly creating liquidity first, grabbing some liquidity, I mean not creating liquidity, but grabbing some liquidity over here, at the same time fill up some imbalances and riding or mitigating this OB over here before going to the upside, grabbing this liquidity high over here, because again, we're still in a bullish trend overall on this daily time frame. Lower low, lower high, I mean this technically was a lower low, but since it broke structure over here, so we can change this up to a lower low, higher high. So we're expecting a higher low and a continuation to the upside, another higher high, higher low. Again, basic structure. Everybody should know this, because again, if you don't know market structure or order flow, and that is one of the reasons why possibly you're losing out a lot, because you're probably this point, let's say you're taking a sell here without looking at the overall market structure, that it's currently bearish on that specific time frame. So again, we are going to talk about the lower time frame versus the higher time frame trading. So what I mean about lower time frame trading versus a higher time frame trading, honestly, is because we believe in the fractal nature. So we believe what happens on higher happens on the lower. The huge difference on doing a lower time frame trading is the duration of the trade is drastically lower. So again, I'll show you. For example, let's say this is a 4-hour chart, and again, what do we see? Break of this liquidity high over here. So we're expecting price to continue to create a lower high and continue to the upside, right? So what we do is, as smart money traders, we see the order flow, which is currently bullish. Then we see an OB over here. So we're expecting price to tap this OB and continue to the upside. Again, we can also look for confirmation over here to add more probability, or to add more confidence on this setup that price actually wants to go to the upside. So we have this OB over here. Remember this, for example, a 4-hour chart. What we can do is we mark it up, then we can target the previous higher high. Let's say price tapped it and continue to the upside. Again, if this is a 4-hour chart, let's just relate it to somewhere here. This could take, oh my bad, this is not the 4-hour. Roughly 4 hours, so 4 hours per candle, roughly a week, 2 weeks, I don't know, but roughly a week. I don't really know, because I don't do this, because again, we believe in the fractal nature. Now imagine this happening on the 1 minute time frame. Now this current setup or this current trade from opening this trade to taking profit literally could just take 15-30 minutes, an hour. And that's the biggest pros of trading on lower time frames, because again, the duration of the trades is way more faster, and again, you can take way more trades since you can see more setups on the lower time frame, or more setups you can join on. So again, we see a higher high over here. You can look for OB over here. Then we can do the same thing again over and over and over in a 1 minute. Then tap this again. Then let's say our take profit overall is from this previous higher high, because we're expecting another higher high to be created. Then this could take the same thing an hour or 30 minutes again. But sadly, the hard truth about it, trading is not that easy. I wish trading is this easy, because again, in 30 minutes, in 2 hours, you could have made 4 plus 3, so roughly 7 RR for 3.44 and 4.08, so roughly 7 RR in under 2 hours. Now imagine if you risked 1%, then you could have made roughly 7% in under 2 hours. But sadly, the hard truth again is, the hard truth about this is not all the time, or this type of trading, scalping, this type of trading is not for everybody. What I mean is, again, since it's a shorter time frame, it's a shorter time frame play, it's a shorter time frame for you to react. You have less time to react on what to do, to review your trading rules, to calculate the risks, to think about to manage your mind, your emotions on whether you should take this trade or not. So let's say this duration of deciding whether to take this trade or not might actually take about, let's say from this high, you're still thinking this is roughly 30 minutes of moving down. So you have 30 minutes to decide to do a top-down analysis, to check your rules, if this is a good idea to take the trade on. So that's the biggest con for me personally. The biggest con on trading the lower time frame analysis is your psychology is your biggest enemy. Okay, imagine now this is a 4-hour time frame. Okay, from this point over here to this point over here, meaning let's say price hasn't touched your POI. Okay, let's just clear this up again. Let me just draw a clear one. So from this point, so let's have a POI over here, a point of interest, either it's an imbalance or an order block, it's up to you. So from that point, from this point to waiting for price to hit this OB over here, so you can react to it, either enter a trade or look for confirmation. On a lower time frame, let's say on a 1 minute, this could take 10-20 minutes or maybe lower. Compared to a 4-hour, this could take what, a day, 2 days, 3 days roughly for it to calm down and tap and continue to the upside. Meaning, if you have 4 days, you can be more emotionally stable. You can think more, oh, I should not take this because the reason why I should not take this, it's overall in a downtrend. So right now on the lower time frame, it's forming a bullish trend, but again, in the overall market structure, it's in a downtrend, meaning you have more time to react to it. You have more time to review. You are more emotionally stable. You're not FOMOing in. You're not thinking, oh, I'm measuring, this trade could possibly pass me on a prop firm challenge. I just need 3 RR more to pass this, to pass my prop firm challenge. That's your biggest enemy is your psychology. That's why you should back this, find your mojo, find your rhythm on what works for you, because again, what works for me might not work for you. Personally, I could trade previously back then, I could trade either 5 minute, 1 minute, or in the 30-second. But again, you have to be on crack, not literally on crack, but your emotions or like a madman emotions, because again it's super fast on the time frame, on this specific on lower time frames, because again you could make in 30 minutes, honestly 30 minutes you can make 7 RR in 30 minutes. It sounds good, it looks good on paper, but again, back then, right now I'm trying to do swing trades, maybe intraday trades, not scalping anymore, because back then my psychology gets rammed up a lot. My emotions, I feel so stressed all the time since it's super fast paced. Imagine sprinting all the time. Obviously, you would be out of breath, you would be hardly breathing because you're sprinting. So if you're sprinting, then it's way more faster to get to from point A to point B, but you could use a lot of energy. It could be stressful. Let's say if you have I don't know, a heart disease or something, you could literally die by stressing out your heart. It could be stressful. Your muscles would cramp up or something. But unlike just walking normally, it would take some time from point A to point B, but it's more calmer. Your emotions, you won't be tired, you won't be stressed. It's the same thing with trading. Scalping, again, it can, for me personally, I believe that scalping is the same thing with swing trading, but the huge difference is just the time. But the major con is, for me, it's super stressful, because again, in a day you can trade like 4 times. You can look for 4 trade setups, and sadly, because it's in a lower time frame, it's more prone for you to FOMO in, to revenge trade, taking trades not in your rules, or taking trades because you just want to make up your loss. That's the biggest con in for me personally for a scalping, and that's what I personally encounter on. So again, let's just look on the charts on 1 day on EU. I'm just gonna show you one of my trades I took recently. So we currently on a bearish trend, and I looked it up on this OB over here. As you can see, let's mark up this whole OB on maybe another time frame. This is just one OB, but we can see we have 2 OBs. We have an imbalance also. Then we have this overall zone. Then this was during the NFP, NARM farm payroll something. I don't really know news. I'll talk about it soon. But NARM farm payroll mitigated this, or in short, this is a high impact news. Then again, let's just say you entered on. Oh, my bad. So let's just say, oh, this is actually my bad. Actually mark this up, because I wasn't trading the NFP. So I marked this up. Oh, it was actually this candle over here. So the other candle, or on larger time frames, it already got mitigated, but specifically on the 15-minute, this specific candle hasn't been mitigated yet from the NFP. But today it got mitigated. So again, you could either just enter from here. So from this, just put your stop without a confirmation. And you can just target this liquidity low over here. The reason why you could target the liquidity low over here, or you can even target this OB over here, because again, this could be a overall uptrend, because currently we're still creating higher low, higher high. So we're expecting possibly a higher low, continue to the upside, a higher high, unless we break this zone over here. Then possibly this is now following the overall market structure, the larger time frame structure, for price to go downward, since on larger time frame structure we're still bearish. But for study's sake, we're just gonna use this as an example of lower time frame versus higher time frame trading. So 15-minute OB, a easy 9 to 1 in under what, 4 hours? Yeah, roughly 4 hours, 3 hours. Again, luckily this one is an impulsive move. That's why it's super fast on taking profits or hitting your take profit. But this is an example. Let's just imagine again that the 15-minute is the representing the higher time frame. Let's just use the 15-minute for study's sake, or for arguments, no, study's sake. Then we can go, let's compare it to the 15-second. 15-second representing the super low time frame. Remember, the 15-minute was a quick 14 to 1. As you can see on the specific time frame, we can see Wyckoff over here. Let's just do a replay so we can do a clear Wyckoff mark out. This is what I use Wyckoff for confirmation. You can go to the 5-second. We can mark this up as the buying climax and the UT. Basically a schematic too. Then you can argue that this could be a UT or just an ST, creation of liquidity, then AR or sign of strength. You can check my other video on how I simplify Wyckoff as a personal view. Then we can enter in the breakout, because again, using very tighter zones. Let's just say you use this. Let's go back to the 30-second. Let's say you use this. Oh, that's the 15-second. So let's just say you use this OB as an entry. Again, this is a super tight OB over here. So you have trade-offs. I made a video about this. You can have trade-offs. If you want a better RR, then you go for a more refined or smaller zone. By smaller zone, what I mean is tighter pips, but it's less probable for price to tap it in since it's a very tiny zone. It's more likely for price to reach that zone, or you can use a larger zone, drastically lesser RR, but it's more probable for price to tap that zone. So this is a 1 pip, but we use this initial breakout. You can check my other video why I chose this breakout, because again, since it's a tighter zone, it's more possible. Again, price could, let's just say at this point, price broke down. Price could literally just go down and continue to the downside and not even retrace near or do a mitigation near this zone. But luckily, this one, not luckily, but still didn't tap it, but it made a tiny bit more, a tiny retracement to the upside. Then we can target the same liquidity low over here. Nope, this is the wrong one. The 15 minutes. Let's make this zone larger. Let's just say on this liquidity low over here. Now this is a 15 to 1. It's the same setup. 15 to 1 it's the same 4 R's, but you made a 15 to 1 compared to the other one, which was I believe a 9 to 1 in the same time period. A 9 to 1 to 15 to 1. So again, this is one of the pros of using or lower time frame, because you can have more trades, better RR again. Then your trade frequency, what I mean trade frequency, the number of trades you take in a day is drastically more, since you can see more setups. Again, this is just a day, remember, and unlike on higher time frames, which could take you a couple of hours or even days to get a setup. But again, as good as it looks on paper, as easy as it looks on imaginary or thinking, but to be honest, I don't prefer this. I don't, especially for new people, I don't recommend doing this, especially going on the seconds time frame, because again, in a day, if you're not ready, if you're not expecting, if you didn't do enough research or back test or forward test, in a day you could lose 5 trades in a single day. Then again, it could be either you FOMO'd in, you revenge trade, or it's just a unlucky day, because again, if you're using high RR, especially if you're not partialing, your win rate is drastically lower. But again, if you did not have enough research, let's just say I'm new, then I use this type of strategy on very low time frames, I'd be thinking to myself, this strategy sucks. I just almost blew my account, especially if you're not risk managing. I almost blew my account. I have a huge drawdown on because I lost in under a day. Unlike if you're doing a swing trade, a entry day type of trading, day trading, more lesser frequency of trades, let's just say a day a trade, or let's just say 3 trades a week. Then you have more time to think about your entries, more time for your psychology, for your emotions to settle down, for you to decide either it's a good entry or not. And yeah, you're more emotionally stable, because it sounds way more better losing 5 trades in a day, or losing 5 trades in 1 week. Because again, you can be more emotional stable. You have more time to think about it. But again, it depends on what type of person you are. But that's one of the pros and cons between higher time frame trading and lower time frame trading. Basically, swing trading versus scalping. So I hope you like the explanation. Thanks for watching.